We've got Karan Taurani, EVP at Elara Securities, joining us on what to make of the GST cuts that we've seen, what happens to consumer durables going ahead, what could be the multiplier effect on the economy, and so much more to talk about. Karan, hi. And good to have you in our studios. Thanks so much for your time today. And let's start by talking about just that. What these GST cuts could mean for the economy, what could the numbers pan out to look like, and what is the multiplier that you're pegging in over here, to reflect on the consumption economy?
So, hi, it's a pleasure to be here. So, broadly, if you look at the GST cut, there's a positive impact of about 48,000 crores in terms of the loss to the government, and this is potentially a savings, for the consumers. And this is actually going to expand the consumer wallet in terms of their potential to spend across various categories. Now, if you look at the math here in terms of the wallet share of a consumer, 40% of that is obligatory spends, which is basically your loans, education, Mediclaim, and so on and so forth. Around 29% is discretionary, and around 24-25% is a necessity. So what we're trying to see here is that firstly, this will have a multiplier effect of about 2 times, which is about 96,000 crores of incremental savings for the consumers in terms of they can spend across these various sectors. But we don't see a big growth or a fillip in the necessity segment because consumers will only premiumize over there. You're not going to eat more food. You'll eat basically a premium brand food or premium quality food. But a disproportionate share of this incremental 96,000 crore, which is 50%, will actually go to discretionary wallet. Now, consumer discretionary wallet has got multiple things, fashion, OTT, food, going out, travel, alcohol, everything put together. So basis this, we've tried to actually analyze in terms of which are the various sectors which will see a positive impact because of this. And within the sectors, which are the various companies which will see a positive impact in terms of revenue upgrades and in terms of EBITDA upgrades.
But Karan, tell me, let's talk about the discretionary spends, wherein you believe that 25% of the pie will go into this. What categories will actually see that uptick in spending?
So if you take the consumer wallet share within discretionary, if you look at the food and fashion and the general lifestyle, these contribute anywhere about 40 to 50% of consumer discretionary wallet share. Now, if you look at the numbers and you deep dive over there, incrementally what we believe is that 6 to 7,000 crores could flow into the food industry, the food services industry. Around 5 to 6,000 crores could flow in the fashion industry in terms of incremental spends. If you look at the online BPC market, you would have 1% of this discretionary wallet, which is somewhere over 500, 600 crores. If you look at alcohol industry, you could have another 800,000 crores to be added in terms of topping of that industry segment as well. So categorically, each of these segments will see a positive impact of about 0.2 to 1.2%. Now, assuming that the market share remains stable for the companies within these segments, there is a potential revenue upgrade in the range of 0.3 to 1.5% for these companies as well. And now, who stands to benefit the most here is actually the QSR chains, because if you look at them, there's a huge fillip in terms of the EBITDA because they've got a high gross margin. You will see a big fillip in terms of EBITDA upgrade. So for something like a fashion company or any online platform, food delivery company for that matter, you may see a revenue upgrade of 1%. But the EBITDA upgrade is 1.5% because operating leverage is low, your margins are low in terms of contribution or gross margin. But in the case of QSR business, the beauty is that gross margins are extremely premium and high. So 1%, 2% of revenue upgrade could lead to a 4 to 5% EBITDA upgrade for QSR companies, which is why we believe that QSR companies are actually best placed amongst the lot within discretionary wallet share if these spends were to move up.
Would it be fair to club QSR with the food aggregators, that's your Zomato as well as Swiggy or Eternal and Swiggy now? Or would you say that because if people will go out to eat more, they will also order in more?
Yes, absolutely. I think if you look at the food category as a whole, up 15 to 20% of the food service industry is led by delivery and the balance is dine-in. We have seen an exponential increase in terms of delivery offtake, both in terms of user addition and in terms of frequency and AOV as well, whereas dining continues to struggle. So I think delivery growing is a structural trend which will go on for another 5 to 7 years because we have ample opportunity to penetrate further into newer markets. But categorically, this spend in terms of discretionary wallet share, in terms of the GST consumption boost, will be a positive for dining as well, and will be a positive for the QSR industry more as compared to the food tech industry. So if you look at the QSR industry, their gross margins are about 70-75%. If you look at the food tech market, Zomato, Swiggy, the other companies, their contribution margin is about 8 to 10%. So the kind of operating leverage positive impact QSR companies will have here will be disproportionately higher as compared to the food tech companies. So with specific to this, in the near term, next 2 to 3 quarters, you could see upgrades on EBITDA, you could see upgrades in terms of growth rates for QSR companies at a higher number as compared to the food tech companies.
Sure, but if you're talking about food delivery companies, Karan, another aspect over here is this new 18% GST for aggregators or service providers, delivery service providers. Could that have any bearing on the fillip that we're expecting to see from the cut in the first place?
So if you look at the GST in terms of delivery charges, generally there were a lot of uncertainties here whether or not the delivery boy or the gig worker is liable to pay the delivery charges, because there has to be certain kind of a income level of 20 lakhs per year, which apparently was not there all this while. So we're yet to explore the actual impact of this, but broadly, let's take 60 rupees is the per order cost is what the food tech players would pay to the gig workers. 18% GST would imply about 12 to 13 rupees a kind of number on a per order basis. Now, they will obviously, will try to recover this from the consumer, because eventually companies are not going to bear the cost of that. So if at all this is implemented, this will have a big negative impact on profitability of the food tech companies. Because if you look at the food tech companies, they've been raising platform fee over the last 1.5 to 2 years from about 1 rupees to about 12 to 13 rupees today. And that's been a very big margin lever for them in terms of margin expansion. Because food commission rates are not increasing beyond a point. What's seen as levers right now is ad revenue and platform fee. So if at all this thing comes in, obviously some impact of this will be passed on to the consumers, but there could be near-term margin pressure basis this. But again, to look at it here, interesting point is that this will categorically have an impact in terms of the low AOV orders, which are orders which are 200 and below. I think those are the orders wherein the consumers may not be willing to pay this kind of a delivery fee or higher GST charges. But for the AOV, which is 300, 400 plus kind of number in terms of metro markets, it will be very easy to absorb this 12 rupees. So it'll have an impact for sure, but not as big as one would assess.
Are we looking at more platform fee hikes?
There could be, obviously, platform fee. So if you look at platform fee, it's a very beautiful business model. Why? Because you actually come to know in terms of which market is seeing absorption. And basis that, you have to keep on increasing that. And it happens in a phased manner. It doesn't pinch the consumer wallet instantly. Even today, if you look at the AOV of 400 rupees odd on the food tech side, platform fee of 12 rupees, about 3 to 4% of AOV only, despite such a sharp increase, and which has led to a very big margin fillip for all these companies. So I think platform fee is a great lever for margin expansion over the medium to long term.
Before we move forward, Karan, within QSR, any preferred list? Because these are also a bunch of stocks which haven't moved as much as your Eternal and Swiggy's.
So Aisha, within QSR, I think one more thing to note here is one is the consumption boost, which QSR companies will obviously see because of wallet share and spends over there. The second big part is that QSR will also be a beneficiary in terms of GST input. So if you look at most of the commodities, whether you call it the likes of cheese, ghee, raw materials, some kind of sauces, seasonings, there has been a massive GST cut there. So I think as per our assessment, there could be a gross margin positive impact of 60 to 80 bips because of this raw material cut, which eventually will be passed on to the consumers, right? So I think value offers will increase. You will see pricing basically coming down. Now, QSR companies have actually been struggling since almost 2.5 to 3 years, wherein they have actually not seen strong LFL SSG growth, except for the likes of Jubilant. And most of these companies have actually seen margin erosion in the range of 700 to 800 bips over the last 2 years, which has been quite bad for them. So I think this will provide them some respite to cushion their margin, basis the value-led offers, and to actually propel growth in a very big manner. Now, what we prefer within the QSR pack is Jubilant Foodworks amongst all the other names. Why? Because one is in terms of the raw material positive impact. Jubilant Foodworks is the best placed here, because 25 to 30% of their COGS is cheese. So they'll see a bigger positive impact as compared to other players. And plus, Jubilant has got a higher ratio or a higher revenue share towards delivery, which is a structural trend wherein delivery is growing faster as compared to dine-in. So I think from that perspective, Jubilant Foodworks, even the valuations are premium, but from medium to long-term perspective, I think there is ample visibility here, rather, that the growth rates will be about 18-20% from medium to long-term perspective.
Karan, I get the whole point about BPC, but the unfortunate part is that there is only that one go-to listed player, Nykaa, right? I mean, because I think Kaya has really been a non-starter in that sense. And I'm not sure if you want to call Reliance, which is now a whole co, as any exposure to a Tira or what have you.
So for Reliance, Tira is very small that way, and Tira has actually not been able to scale up with the likes of Nykaa. They are focusing more in terms of offline than online. Nykaa remains to be the market leader with the larger platforms like Amazon, Flipkart as far as online BPC market is concerned. Now, if you look at the entire perspective in terms of the wallet share, in terms of personal care side, it's about 1.5-2% positive impact, which is what this market will see in terms of offtake. So again, as per our assessment, something like online BPC market, assuming market share remains stable, you could see revenue upgrade of about 0.7 to 0.8%, which is similar for Nykaa as well. And because again, Nykaa, the operating leverage is somewhere slightly lower as compared to QSR companies, you could see a EBITDA upgrade of about 2% over there for Nykaa, primarily basis the consumption boost that we are seeing. Second impact for Nykaa, which is going to be a big fillip, is the GST cut on the haircare segment. Now, as per our assessment, haircare segment is one of the fastest growing categories. It's growing at about 35-40% as far as online is concerned. And this segment will see a big fillip in terms of growth rate because of the GST cut, because there could be possible premization trends herein, which will also have a positive impact on Nykaa. So broadly, putting into account this GST cut on hair care and the consumption boost, we're expecting Nykaa to actually have a revenue upgrade of 2.5% for its FY27 revenues and about 4 to 5% EBITDA upgrade for Nykaa. But Nykaa, I think in terms of valuations, the core BPC segment is largely pricing in the growth rates and the margin expansion. It is trading at somewhere close to about 90 times FY27 core BPC, which is quite premium. Obviously, execution on the BPC side has been good despite the competition from the quick commerce market. But we have to see here that the quick commerce pain is not yet over. There are another 2 to 3 years in terms of quick commerce offtake increasing within online BPC. Because BPC is one product which has got the lowest returns and the most premium margins. So Nykaa would be a key watch here on in terms of valuations. Otherwise, within the QSR pack, within discretionary pack, we continue to like stocks like Eternal and Jubilant Foodworks.
Okay, and Nykaa is also breaking even on their fashion segment, and a big chunk of that is below 2,500. So that could also be another fillip for Nykaa.
Yes, that could be, but again, in the case of fashion, they are quite small. They only cater to the premium fashion market, which is a fraction of the overall online fashion market. And putting that into perspective and giving the premium valuation multiple to fashion, given the break, even the growth rates, everything put together, we'll not see a big fillip in Nykaa on the stock as a whole.
So in that sense, wouldn't Trent be better via the exposure through Zudio?
So Trent, I think we generally like this as a stock, but what has happened over the last 6 months is that things have actually turned unfavorable for them. We have seen increased competitive intensity. Many of these smaller players like Style Union, Style Up are giving a tough fight to Trent. They are expanding aggressively in market. Some of these new players are also playing on the value and quality side, whereas if you look at Trent, they play on value and style side. So they're actually leading to a price war or a compression in margins for the newer players, and aggressive expansion has actually weighed down on growth for Zudio over the last 6 to 8 months. Now the only respite is Trent has somewhere been able to hold on to their margins despite this competitive intensity. So if there is no negative surprise on margin, again, Trent from medium to long term perspective does appear to be a good buy because if you look at valuations for Trent, we're getting at about 57, 58 times FY28 P, which is -1, -2 standard deviation. So obviously growth rates for Trent have also converged from a 40% to a 20%. But if we see Trent is able to sustain margins over the next 3 to 4 quarters despite increased competitive intensity, you could see some potential upside over there as well.
Okay, so Nykaa from BPC, Jubilant from QSR, but what about staples, your white goods, durables? What would be your pecking order there?
So generally in terms of staples, if you look at wallet share, as I said, staples will only see mild premiumization trends. So even from a staple side, you will not see an upgrade of more than 3 to 5% because of premiumization. And I think in terms of white goods, the wallet share is far smaller as compared to food and fashion. It's about 1.5 to 2% in terms of discretionary wallet share, or in terms of overall consumption. So then also you will see offtake, but not in a big manner. So fashion followed by food are going to be the two biggest beneficiaries of this. Then there's also alcohol sector. Alcohol is about 0.4, 0.5% of consumer wallet share in terms of the spends. You could see premiumization trends therein as well. So then also you could have a small impact of 1.5% on EBITDA upgrade for companies like Radico, United Spirits, United Breweries. Unfortunately, in the case of Alcobev, they do not have any raw material positive impact. Because ENA has not seen any kind of GST because that's a fixed GST because Alcobev subject, the GST hasn't come off over there. There is some minor respite for Alcobev companies in the form of packaging charges coming down because of lower GST. But packaging, as we all know, is 15-20% of their COGS. So alcobev companies will see a small respite as compared to QSR and food tech companies.
Right. But Karan, so great having you in the
Great.
studios. Thank you so much
Thank you so
for
much. Pleasure
giving
to
us all that insight.